Welcome to the deep dive. Today we're taking a close look at Türkiye Sigorta A, that's TRSG, on the Borsa Istanbul. They've got their third quarter 2025 consolidated financials and activity reports right here. Our mission: to really get under the hood beyond those big headline numbers and see what it means for you, the individual investor. What are the real risks and the potential rewards?
Yeah, and when you first glance at these reports, it's almost like two different stories, isn't it? On one side, you see really impressive stuff, confirmed sector leadership, premium growth, just soaring.
Right.
But then you look at the financial structure and, well, there's signs of some pretty aggressive moves. A huge shift in cash and debt that, frankly, changes the whole risk picture.
That tension, that's exactly what we need to explore today.
Yeah.
And hey, if you find this kind of breakdown useful for getting up to speed quickly on investment topics, please do give us a like, subscribe, and maybe share this deep dive. It really helps us out. Okay, so let's lay the groundwork. Türkiye Sigorta. What are we talking about here? It's a major player, headquartered in Istanbul, formed back in August 2020, right? Through merging Güney Sigorta, Ziraat Sigorta, and Halk Sigorta.
Exactly. And that wasn't just, companies deciding to merge. It was part of the new economy program, a deliberate government-backed push to build up Turkey's non-bank financial sector. And the result? It's the largest insurance company in Turkey, the leader, focusing entirely on non-life insurance, things like fire, natural disasters, motor, health.
Yeah.
Works.
And you can see that leadership in the numbers.
Yeah.
As of September 2025, they've got, what, a 14% market share? That's pretty dominant, serving 6 million customers through, wow, nearly 4,000 agencies and almost 5,000 bank branches. That's a massive distribution network.
It really is. Now, the ownership structure is key here, and it's very concentrated. The main shareholder is TVF Financial Yatırımlar AŞ, holding 81.1%.
Okay, 81.1.
Which means only the remaining 18.9% is actually floating on the Borsa Istanbul's Yıldız Pazar. So the majority owner has very firm control over the company's direction.
Right. And looking at who's running the show, Aziz Murat Ulu is the chairman, Taha Çakmak is vice chairman, and also the general manager. Does that ownership structure translate into, say, how they manage personnel or compensation?
Absolutely. You see the scale reflected there. They employ just over 1,500 people, 1,546 to be precise. Now, the board is mostly male, but there's one female independent board member, Ayşe Türkmenoğlu, and importantly, 3 female deputy general managers, Çiğdem Kılıç, Melike Nurçınar, and Tuba Buldu.
Okay, good to know.
And yeah, reflecting the company's size and performance, the short-term benefits paid to senior management over the first 9 months, 87.6 million Turkish lira. Also worth mentioning, they fully own Osim Certificasyon and have a 50% stake in Türkiye Sigorta AŞ, so some subsidiaries there too.
Okay, that paints a clear picture of the company's structure and scale. Let's pivot to how they're actually performing operationally. The engine room, as you might say. Premium production zero, it took a huge leap, didn't it? 9M 2025 hit 105.1 billion TL. Compare that to 72.5 billion TL in the same period last year. That's a 45% increase. Pretty stunning.
It is stunning. And what's really interesting is where that growth spurt came from. I mean, yes, general lines grew, but a couple of areas really jumped out. These are the aha moments, right? Health and illness premiums, up 122%.
Wow.
And watercraft insurance, things like boats and ships, up 131%. That's not just steady growth. That suggests a really aggressive and successful push in those specific areas. Maybe better pricing, maybe grabbing market share.
But okay, big growth in insurance often means big volatility in claims, right? You write more business, you pay more claims. And sure enough, gross claims paid were up 83%, from 21.7 billion TL to almost 40 billion, 39.8 billion TL. But here's the kicker, the bit that makes you go, woo! General damages claims, they spiked, wait for it, 519% compared to last year.
Yeah.
519%. That looks absolutely terrifying on paper. How do they stay profitable when one claim area explodes like that and overall claims rise way faster than premiums?
Right, and this is where the technical side of the analysis really shows their strength, their operational skill. Despite that enormous spike in claims, their core technical result, which is like their operating profit before you factor in investment income, it still grew. It was up 41%. From 12.4 billion TL to 17.6 billion TL.
Hold on, so they're actually making more money from the basic business of insuring things, even while paying out vastly more in claims. How does that even work mathematically?
It comes down to strong underwriting discipline and risk selection. The key metric here is the net hazar, or net claims, to premium ratio. It basically shows how much of every lira earned in premiums goes out to pay claims. And that ratio actually improved. It dropped from 77% last year down to 73% in the first 9 months of 2025.
Ah, okay. So they got better at pricing risk or selecting less risky business.
Exactly. It shows really good efficiency. The premiums they're bringing in are more valuable relative to the risks they're taking on. And maintaining that core technical strength is crucial, especially because they have to hold massive technical reserves, the Mulak Tazminat Karşılığı. As of September 30th, that stood at 25.8 billion TL. Huge amount.
That strong core performance definitely feeds into the balance sheet, which also saw big changes. Overall, the company's just bigger. Total assets are up 58%, hitting 151.2 billion TL, and equity grew too, up 46% to 40.6 billion TL. Net income for the 9 months looks very healthy, up nearly 49%, reaching 14.4 billion TL.
Yeah, but that jump in net income isn't just from good underwriting. It got a massive boost from their investments. Net investment income absolutely surged by 464%. That's almost unbelievable. It went from about 838 million TL last year to 4.7 billion TL this year.
464%. Wow.
And the driver was mainly financial investment income, which itself was up 62% to 17.7 billion TLL. Especially in a high inflation environment like Turkey's, this shows they've been very effectively playing the financial markets with their capital.
Okay, but here's where that tension we talked about at the start really comes into play. This is the puzzling part. If they're so profitable, core business is strong, investments are booming, why did their cash position take such a huge hit? Cash and cash equivalents dropped by almost half, 45%. Fell from 24.5 billion TL down to 13.5 billion TL. Where did the cash go?
Well, that cash drop lines up almost perfectly with a massive and I'd say pretty aggressive change in their short-term financing. Look at their short-term financial liabilities. They just exploded, surged by over 1,000%.
1,000%.
Yeah, from 1.5 billion TL last year to a staggering 16.6 billion TL this year.
Okay, wait. So a tenfold increase in short-term debt and nearly half their cash disappears. That's not just tweaking things. That's a fundamental strategic shift. What's the thinking there?
Well, it tells you management is willing to use significant leverage. They seem to be funding growth and maximizing those investment returns we just saw. They're diverting cash into those higher-yielding investment strategies, perhaps. And at the same time, they're drawing heavily on short-term credit. You probably need that kind of flexibility to manage the cash flow demands of 45% premium growth and those huge reserve requirements. It fundamentally changes the company's profile, though, from quite conservative and liquid to much more aggressive and leveraged, almost overnight.
And another big structural change, their paid-in capital doubled, right? From 5 billion TL to 10 billion TL.
Yes, that was a really important move, approved back in June 2025. A 100% capital increase. And crucially, it was funded entirely from their 2024 net profit. So they used internal earnings to bolster the capital base. This helps meet regulatory capital requirements, strengthens the balance sheet for more growth, and it's a big reason why total equity jumped 46%.
Okay, so lots of moving parts. Let's try and translate this volatility into what it means for someone holding the stock. Let's look at the valuation ratios as of October 20th, 2025. The price-to-earnings ratio, PE, stands at 5.71. That's actually slightly down from 5.8 previously.
Right. And the price-to-book ratio, PD, is 2.39, also down a bit from 2.58. So what that suggests is, despite being the market leader, the valuation might have become a bit more reasonable, maybe slightly more affordable relative to earnings and book value compared to before. It doesn't look excessively expensive based on these metrics.
And the annualized return on equity, ROE, still incredibly high at 53.06%. I mean, that's fantastic, even though it's slipped a bit from 58.89%. And ROE over 50% is just phenomenal capital deployment.
It is. But we need to tackle the paradox created by that big capital increase we just discussed, and that's earnings per share, EPS. Despite net income jumping almost 49%, the EPS actually went down, from 2.14 TL last year to 1.74 TL this year.
That seems totally backwards. Profit goes up, but the earnings per share fall. It's a classic dilution effect. Because they did that 100% capital increase, they effectively doubled the number of shares outstanding. So that bigger profit, the 14.4 billion TL, now has to be spread across twice as many shares, which naturally results in a lower earnings figure per share. It impacts how investors perceive the value right away, even though the company as a whole made more money.
Okay, that makes sense. Dilution. Finally, the PEG ratio, often used for growth stocks. The sources report it as negative 0.29, which is down from negative 0.11.
Yeah, and we have to just report that figure as it's derived from the data provided in the sources. With the kind of volatility we're seeing in earnings growth in the underlying figures, getting a negative peg is sometimes just a mathematical outcome of the formula interacting with that specific data set. It doesn't necessarily signal something specific on its own in this volatile context.
Got it. Now, looking back at the stock price itself over the past year, it's been a strong performer, hasn't it? Between October 2024 and October 20th, 2025, the stock gave a 66.68% annual return in Turkish lira. That's very competitive. Over that time, the price went from around 5 lira up to a peak of nearly 10 lira, 9.99 TL. And it closed right near that high at 9.95 TL, which is about 24 US cents.
Yeah, and it's crucial for investors to remember the context there. That 66% nominal return in lira needs to be viewed against Turkey's high inflation rate over the same period. So the real inflation-adjusted return would be lower, but still likely positive. And one more really telling detail. The day these financial results were released, October 20th, 2025, that saw the highest trading volume for the entire year. 62.6 million shares changed hands. That tells you the market was paying very close attention to these numbers and reacting immediately, pricing in both that fantastic income growth and, likely, that new layer of financial risk from the debt increase. So to wrap it all up, Türkiye Sigorta is clearly a dominant force, using some pretty aggressive strategies to drive profit. You've got huge premium growth, strong net income, really boosted by smart investment plays. But if you're an individual investor, you absolutely have to weigh that against the big structural shifts and risks. The core challenge here is balancing that great technical performance and the stronger capital base against the fact that they've burned through nearly half that cash and taken on 10 times more short-term debt.
Yeah, what really strikes me is just how fast everything changed in these 9 months. Management clearly decided to hit the accelerator. They restructured aggressively, doubling capital, using profits, while simultaneously ramping up leverage like crazy. So the big question for investors now isn't just, did they make money? It's, how are they going to manage that 16.6 billion lira in short-term debt over the next few quarters? That seems like the key thing to watch.
Absolutely. Well, hopefully this deep dive is giving you a more nuanced picture to help you think through that investment decision.
And if this discussion was helpful for getting a quick, insightful handle on a complex company, please do support the deep dive. Like, subscribe, share it around. We appreciate it, and we'll see you next time to continue the learning journey.